Hey, what's up, guys? Sam here. And we're going to be kicking off a session today regarding the yield curve dynamics. Very exciting topic, I'm sure. I'm not used to all of these little badges that you guys have. I think that's the first time I've seen that. They have to fix that. They have to have it so that if you hover over it, it tells you what it is. Huh. I'll give them some feedback on that. Also, there seems to be too many of them. There's a lot of badges there. You got trophies and graduation caps and fire emblems, and that's a lot of stuff. I'm going to give them some feedback on that. All right, so let's dive in. Yeah, we don't need no stinking badges. So let's just jump really quickly to the price action. Then I'm going to rely on you guys a little bit for questions. So I'm just going to present a lot of things that maybe some of you, I know a lot of you, just because I recognize your names, have seen this before. But now the signal is right in front of us, right? So I've been kind of leading you up to this and telling you, hey, don't worry about it until the signal gets right in our face. And the signal is now officially right in our face. So now it's time to really get serious about things. So we'll dive into the yield curve stuff here in just a moment. But let's just maybe cover some price action here. So the banks are getting smacked up today really badly. And you did get a little bit of a flush here. I want to just put a couple levels on your chart on the ES. So one, I have this working theory that started during my session in the gold room that below 60 is a bear trap, right? Basically, you have the overnight lows through here. You have the 200 there. You have the lows from yesterday there, right? So when you sketch it in, you have the low from yesterday, or at least near the closing low. You have that low from this morning. Everyone's going to have the same stops. This move kind of picks them all off. And as long as it trades above 60, the potential for a trap is certainly in play. Now, the signals here are not particularly good, but above 60, I'm giving them the benefit of the doubt. The real level that needs to break is going to be 89 to about 95. 89 to about 93 is really the level. If they can break above that box right there, then there's going to be a lot of energy to the upside. You'll get this move in reverse, in my opinion, but you got to get above at least 90 to 93 to create that. This kind of sets the spring. Think of this as kind of a spring loading the situation, and then you can go that way. Now, again, it's not easy for me to say that, and nor do the signals currently imply that that is the reality, right? Because if you look at it, it's still a bearish situation. You're just kind of coming back into your 5-minute bearish cloud. So the signals aren't particularly good for that, but the idea holds true as long as they hold it above 60. If they break back below 60 at any point, this entire idea goes into the bin, and the bears will win for the day. So that just covers a little bit of the price action there. Follow up from what we were looking at in the gold room. So let's dive into why we're all here, just to talk about the scary stuff that is the curve. So we are recording, so I'm just going to go and maybe start with the basics, which I'm sure most of you have heard or are aware of. But just to make sure that we all build up the one common point. So what is the yield curve? A yield curve is the difference spread between two different maturities. So think of an example. I want to borrow money from you. I can either borrow for 10 years at 5%, random number, or I can borrow for 2 years at, let's just say 4%. Okay. So this probably makes sense, right? This just immediately makes sense. This is your lived experience. The longer that you want to borrow money, the more that it will cost, right? So the longer you want to borrow money for, the higher the interest rate will be to compensate the lender, you, in this instance, the lender, for the time risk, right? So we all understand that. That's just our lived experience. We know this, right? Like if I wanted to borrow money for a week, it would probably cost me way less than it would cost me to borrow money for 10 years, right? Because a lot more things can happen in 10 years than in a week. This is normal. And likely your lived experience confirms this. Inverted yield curve is the opposite. In that instance, borrowing for 10 years may cost, let's just say 5% again, random number. But borrowing for 2 years may cost 6%. I try to make sense of that. Why anyone care to take a guess as to why that might be? What's the psychology there? What's the rationale? How does make it make sense? How does that make sense? Any takers? Bueller. Yeah, that's exactly it. In two different ways of saying it, but both were correct. Near-term risk, uncertainty in the short term. So basically what it means, and I think you guys got the right answer, basically it means that the bond market, much smarter than the degens in the stock market. Stock market equals emotion, bond market equals logic. I say that just because it's important to understand that the bond market knows a lot more than the stock market. But basically means that the bond market is pricing in more risk in the near term and less risk or deflation in the long term, right? So basically it's just backwards. Everything just becomes backwards. So that's the basis of it. If you guys have questions on that, let me know. But that's basically just the long and the short of that. So let's get to where it matters for us as visual people and as people that are frankly we're here to make money, right? You guys aren't here to learn something or to be in school. This isn't a test, right? You don't have to wake up early for this. But you want to know how to take this information to make money off of it, or how to protect your money, even, right? Maybe even more so. So let's look back at periods of time where this inversion has been the case. Inversion happens when you're down here. Right? And maybe I should just get rid of this box up here. That makes it simple, actually. Let's do that. So getting a little bit of movement here in the market, which is good to see. Kind of confirms my theory from earlier that there's a potential squeeze here. Keep it going. Keep it going. So this is a chart of the yield curve. If you want to know what it looks like on TradingView, I'm going to give it to you. And then I'll give you the ticker for it on Thinkorswim. So on Thinkorswim, it's the 10Y, 2Y. So if you're watching this on any other channel that's not in the simpler ecosystem, see what I'm chatting, just go back and check out the recording, and you can grab the tickers from there. Here's a ticker for it on Toss, if you care to have it. So this is what it ends up looking like. And the box down here is when things are inverted, right? So basically it's that wonky situation we just talked about where folks want more money to borrow for short term than they do for long term. Makes no sense whatsoever. And frankly, you can actually take advantage of it in the short term. You know, if you're doing like T-bills, like I've been doing T-bills through Treasury Direct, and they pay a lot. I mean, for 4 weeks you get 5%. That's pretty good, right? Now that is annualized, but 4 weeks for 5%. I mean, I haven't seen that in my lifetime. So there's ways to take advantage of it. But again, just to get back on track here, the green box is inversion. Basically, the top line of the green box starts at 0. So anytime that this chart is below 0, that's inversion. And that happened in 89 and 90. That happened in 2000, 2001. It happened in 2007, 2008. It happened again in 2019. And it's happening now in a giant way. What do these dates have in common if you know your market history? Well, some of these are very obvious market history moments, right? 2000, 2001, that was .com. 2007, 2008, great financial crisis. 2019, a little something called COVID. Back here, I think it was Japan or savings and loan. I'm not sure which one. Could have been both. So historically, there's 5 moments, 4 of which have already happened. So we can see what happens after the inversion, right? You go into inversion, you get the big spike up. You go inversion, you get the big spike up. You go into inversion, you get the big spike up. And then here with COVID, you got a mini spike up. And then they printed more money that has ever existed. And we went back into inversion. But notice that each one of these moments of inversion, what you'll traditionally hear is that it tells you that a recession is coming. I don't actually care about that. I don't even know how to define that necessarily, nor do I care about it. I think that defining a recession is kind of like saying a bear market is 20%, right? Like a bear market's not 19%. It's not 25. It's an arbitrary measurement. What I can tell you though is when this chart goes from inversion and rips out of inversion, historically, and if you know your market history, it has basically tanked the market. Back here, it was like 80% in the Nasdaq, right here it was. Great financial crisis. 30% down for COVID. I'm not sure how much it was back here. I was a little too young for that one. And so essentially what this does is it tells us, yes, it does in some way, quote unquote, predict a recession, but that's not what's relevant. And that's not going to help us make money. What it does tell us to do is it tells us to start getting a little bit more careful and potentially even slightly leaning bearish as the signal develops as we start trading and investing. And so I want to point out one thing here. And this is unproven because this is the one that hasn't happened yet. You see this moment of inversion there and that moment of inversion there. They're pretty much the same level, right? This one wasn't as deep, but it's inverted. And then this one was certainly like the most shallow and almost barely inverted. But look how long we've been in inversion for 3 years. Now, during inversion, stocks can certainly go up, and they definitely have, right? So be aware of that too. It's not the inversion that creates the problem, it's the rip out of the inversion. When you're inverted, you actually want to be in Mag 7 stocks. The last 3 years, if you've been in the Mag 7 stocks, you've done quite well for yourself because the inversion is helping you in that situation. But the reason that this session is so important now, as opposed to when we've done them before, is because now you can see the little value here. You see how it's a positive value? That means that we are breaching the green line. And the green line is kind of the warning sign, right? So, and then even more importantly, when it happens very quickly, right? You can see that these are very, very sharp moments in time. And as I show you the curve over here, this is a little in the weeds, but look how much in percent terms this is up today. Just today, this is up 61%. Now, it may not seem like a lot because the numbers are very small, but 61% a day, if it's up another 60% tomorrow, it starts to add up pretty quickly. So you start to get vertical moves here pretty quick. So long story short, we've been talking about it here. And my thesis is that the deeper and longer the inversion, in the exact same way that I would look at a stock chart and say that the bigger the base or in space, that old term, the deeper and the longer the inversion, the bigger the problem will be. And this is by far visually the biggest inversion that you can see on the chart. So my thesis to you is that once we actually see this spike up historically there and there and there and back here, this is going to take the market down probably somewhere in the neighborhood of at least 50% from here. Right, at least 50%, because this is the biggest inversion we've seen yet. So a little bit more nuance here. So let's zoom in. Keep in mind, being inverted is not the problem. It's the rip out of the inversion. So during this entire time, this is a monthly chart. It doesn't look like a lot of time, but that's like almost 3 years. During this time, you want to be in tech, right? You want to be in tech. Once the inversion starts to occurring, or the uninversion, the move higher starts occurring, you actually don't want to be focused on tech. You want to be focused on staples. You want to be focused on pretty much everything that's not tech, essentially, because all of the laggards run pretty hard. If you go back and you do your market history and you go back and you look at 2000, like .com, for example, towards the time when that started getting uninverted back in .com, the tech stocks stopped going up. Now, they didn't crash, but they stopped going up right about here. Or excuse me, that's wrong time frame. They stopped going up right about here. And what happened? The staples went up 20%. Staples, boring old, toothpaste and toilet paper kind of staples went up 20%, right? And tech traded sideways. And then once the staples ran, and I'm just using the staples as a catch-all for everything that's not tech. Once the staples ran out of juice, then that's when tech rolled over. And then finally, everything rolled over, right? So it's kind of like at the end of the cycle, they start doing all the things that weren't the leadership during the last cycle, essentially. So that means everything except tech, right? Now, of course, you can have days like today, where tech is doing quite well. We have some Tesla in the room when that's doing decent, and Amazon's doing quite good. But in general, during this time right now, you want to be a little bit more focused away from tech and keep an open mind that things like staples, utilities, healthcare, industrials, things like that weren't leadership can actually have big moves from here. Now, that's the second phase. This is the first phase. The first phase is tech. The second phase is where we are in now, and that's everything but tech. And then the third phase is what's to come. And the third phase, you want to be nothing. The third phase, frankly, nothing survives that. just to keep it, be upfront with you on that. Fortunately, we're here. I think we're in the later parts of the second phase. We have not entered the third phase yet. But when you do enter the third phase, you don't want to be in anything. The only thing I think that will work in the third phase is going to be TLT, bonds. So that's the way that I would approach that situation. So we're not there yet, but understand that today, more so than any time we've ever done one of these sessions, the level has been breached, right? You can see there. The green line has breached. So that pretty much is the long and short of it. If you guys have any questions regarding any of that, I'm happy to help. But that's essentially it. And of course, the question is always, well, how do you play that? And since we're in the second focus on, basically everything that's not tech, and I can show it to you on a chart very quickly as to what that looks like. And when I say focus on not tech, I just mean from like thinking that you can sit in a trade and just ride it out. So, like, you know how Nvidia was like just the gift they kept on giving. That shouldn't be true any longer. So this is a chart here, or a series of charts that show SPY and all the sector ETFs. And notice the only places that are green, right? The SPY is neutral. XLB is a neutral. XLE is just red. XLF went neutral today after the smack. XLI is neutral. XLK is neutral. And SMH is neutral. So, and then XLY is actually starting to shape up here. That's pretty good. So where do you have some energy? Well, you're going to have energy right about in here. XLP, XLU, XLV, XLY. These were not leadership groups on the way up. These are not leadership groups on the way up. And also, and if you're paying attention, these are not sectors, staples, utilities, healthcare, and discretionary that can really hold the market up. Because if, you know, over time, of course, if you lose XLK, what's worth more? Microsoft plus Apple, or the entire utility ETF? Probably Microsoft and Apple is worth, probably Apple alone is worth more than every utility in America. So from a weighting perspective, you know, if you think about your horses, your best horses to move markets are XLK, XLC, SMA, maybe a little XLF. Those are going to be your best horses. These are not your best horses. These are, you know, in terms of market moving horses, these are basically mules. So again, just you're seeing it in the charts: XLP, XLU, XLV, XLY. Try to focus there, and also understand that sectors alone cannot actually keep markets buoyant for too long once they've run their course. So excuse me. That's the song. That's the dance. We talked about the first stage, which is the inversion. The first stage of, and this will happen again in the future, so just you'll remember it. First stage inversion: buy the deflationary stuff, buy tech, anything that benefits from really low interest rates, buy all of that. So first stage, buy tech. Second stage, buy everything but tech, mostly, with a focus on like staples, utilities, defensives, essentially, because defensives will then start to run like tech did in the first stage. And then in the third stage, which is where we're going, we're not there yet, ideally. But in the third stage, which I think we'll be in probably less than 6 months, in the third stage, you actually don't want to buy anything. You don't want to even, not even gold. The only thing, in my opinion, historically that has worked during third stage is bonds. So you just buy TLT. So, and then of course, index puts would certainly do well in most situations like that as well. All right, so from there, we'll go ahead and take any questions if there are any. And sorry for the folks on platforms, I don't have a way to read what you're asking. So actually, maybe I do. I do actually. Okay, let's actually start with those folks. So how about TLT options plays? Yeah, no, I like it a lot. I think the TLT here is a great play. There was I was trying about a month ago where I was buying the Delta 70 TLT calls for October, and I was buying one or two every day. And so, and then I just got a giant move and I just decided to sell it all. So I was buying TLT calls through here. And I was buying like one every day, two, sometimes two or three every day. I got this giant pop and I sold it there. Of course, that was, and then the Monday was the crash day. So of course it went higher than I sold it. So I accumulated a chunk there and I sold it here. But I like that strategy. I haven't gone back to it. And I really should have, because, you know, once it fell into the cloud there with nothing but green arrows, I mean, that's a buy. But really, the TLT is one that's better appreciated on the longer term. So if we go to maximize the sell here, you see how the cloud is also starting to turn here? See this? See the red cloud there? So you see the pinch points. This is something that I shared in the drive. Actually, I'll give it to you guys in the essentials room. Let me upload it here to have access to this file. So I've shared it in the or in the central room. But if you guys want that cloud, I just uploaded the file to the room drive. You can grab it there. It's just a 2150 moving average cloud. Let's see, it goes from green to red right there, right? So from this period all the way to here, which is 2 years of change. You see how it's red? And then if you zoom in, it's now green, right? You see how it's gone green and now it's being supportive. So that's point number one. Point number two is then I have to ask myself, okay, well, does this look like a potential giant bottoming pattern? And to me, it does. To me, it actually does. And there's a lot of reasons here why trades I probably should be like really big allocation here because you have to see this. Look at what I'm about to show you here. Does anyone see that pattern? Anyone see what I'm pointing out here? No, look at the combination. Sorry, I should be a little bit more specific. Look at the interplay between the indicator and price. What do you notice? You guys are looking at the price, and you're not wrong. I mean, you could call that you actually could call that a giant head and shoulders. You can call this kind of a giant cup and handle. I mean, there's a lot of ways to look at this. Now I'll just go ahead and give you the answer. So check this out. You have a low here. You have a significantly lower low here. Right? Price big time down. Why is the indicator going up? See that? Why is the indicator significantly higher here with price lower than it was here with price higher? So what is that? What is that? It's a positive divergence, and it's actually a very, very notable one. It's a giant one. For those of you that are unfamiliar, just why this is so important, let me show you one that's already played out. Because a positive divergence, think of it like it's like a rocket booster under a stock. Like it's kind of invisible if you don't have the right tools to see it, but when it plays out big. So let me show you just one real quick that's already played out. Yeah, I can use the same drawings. This is the QQQ. See how price is going down? Right? We all agree on that. See how price is going up? Or momentum is going up? That's the exact same pattern I just showed you on TLT, right? Price going down, momentum up. Look what happens. From 250 down to almost 500. It doubled. What kicked it off? What gave it all that energy? This is a coiled spring. So that's one that's already played out. And I'm feeling under allocated to bonds as I show you all of this. In my retirement account, I'm all in bonds, but I feel like in my trading account, I probably should have more. So let's just finish the thought process here because you mentioned TLT. And there, I mean, you guys are not wrong to call out that head and shoulders or the cup and handle. It really doesn't matter what you call it. It's, as long as you understand it's a basing pattern. You can ink blot test that however you wish, but understand that there's a massive positive divergence. You can call it head and shoulders. You can call this a cup and handle. You can call it a double bottom, a higher low with a flat top right there, right around 100. But long story short, there's a room here to go. And if this idea is true and we're entering third stage, maybe not in this exact moment in time, hopefully not, hopefully we have a couple more months to go before we reach our final stage. But if this is true, where would you target? Well, you would target this previous support zone, right? You target this previous white line here at around 110 to 112, and then you target the red line, which is 116. That's a big move. It's a big move, and it's worth playing. And lastly, so let me, because I feel like I bounced around a lot. Let me just give you the 3 technical points here, so we all speak the same language. 1, cloud flipped after 2 years, right there. From there to there, completely bearish. You should not be buying bonds. Once it flips, point two, price goes down, momentum goes up, positive divergence. Point three, visually, giant reversal pattern. So yeah, long story short, TLT I think does work in quite a large way. The way to play it, I actually think this is actually still pretty reasonably priced. So I think just giving yourself time, maybe at least until January for most people, makes the most sense. And either doing call debit spreads, over some ideas around doing really wide butterflies, which I think are a good idea as well. So there's a lot of ways to get exposure here. And now that I've pointed all this out, I had not noticed that positive divergence before, nor had I noticed that cloud. Now I feel really underallocated here. So this is actually probably, if I had to pick a trade that's I think going to be a huge winner going into next year, it's probably this one. All right, so I'm going to keep going on the questions. Have anything else? TLT or TBT? No, TBT is going to be the inverse, I believe. So you'd want to go to TLT. What do you think will happen to crypto? Crypto's a tough one. My bias is that it will have the same fate as gold. So I think a lot of folks think that gold is a place to go for safety. But if you look at it, that's not actually true. At least not during credit events. And this is essentially what it boils down to. So maybe I'll just put that in the notes. What it all boils down to, that's actually pretty important. Credit event. That's the reason why. It's a credit event. Just to give you kind of an analogy so you can understand, being inverted, like I've shown you, where the level is below zero, and especially for this long when it was inverted for almost 3 years. Think of that like somebody who's going to McDonald's and eating like 10 cheeseburgers every day, right? And then all of a sudden, one day they have a heart attack and die. And they're like, how did that happen? Well, they were eating they're eating 10 cheeseburgers every day from McDonald's, and then you got the heart attack. This is the eating the cheeseburgers phase. We haven't gotten to the heart attack phase yet, but that would be kind of how I would relate that. So the heart attack would be the credit event. There's always a credit event that ends this, right? It's just always the way it is. Sense to crypto, it's so difficult to say because crypto wasn't around during this. It wasn't around or this for a historical measure. We could go back and see what happened with crypto in 2019, and maybe that would give us a clue. My bias would be that it goes lower. And the reason I say that is because during credit events, even gold goes lower. So you can maybe prove me wrong, go back and do this one on your own. I won't do it today, but go back and see what happened with crypto in 2019. If it performed well, then there's a chance it might perform well. Historically speaking, though, during credit events, everything that's not nailed down gets sold. How does that relate to small caps? Small caps would probably tend to get hit the hardest. They're the most, they're the weakest parts of the economy. What about keeping the index plays? For now, we're still, in my opinion, stage 2, although we're in the latter stages of it. So I would focus more on like the Dow, because the Dow is more, it has less tech exposure than, and it's not small caps. So basically, earlier we looked at utilities, staples, healthcare, and I think consumer discretionary. And then everything else was like not that great. So the Dow would be the one to focus on, if that's what you mean. Top sectors on the upside, outside of an inversion. The junk stocks probably won't do particularly well. I mean, that would be pretty rare. You're playing TMF, which is the levered version of TLT. That's not a bad way to do it. I prefer having the gamma of long dated TLT calls because with TMF you're going to get one for one with shares. So the reason I prefer like Delta 30 leaps on TLT is because you start with a little snowball, Delta 30, and then by the time it rolls down the hill, you have a giant snowball, right? Because that Delta 30 has become a Delta 40, Delta 50, Delta 60. Whereas if you do shares, you have a little snowball. And then by the time it gets down to the bottom of the hill, you still have a little snowball. So, but I mean, if it works, there's no wrong answer really. The setting of the cloud is a 21 EMA and the 50 SMA. Gorged on cheap debt. Yeah, no, for sure. Is the cloud indicator available for TradingView? I didn't make it for TradingView, but it's very, very simple. So I'm sure if you just type in like 2150 moving average cloud, you can probably find it. I know actually some folks have just typed it in and found it. It's extremely simple. It's just the 21 and the 50 moving averages blurred together. And then lastly, what are some credit events that could play out? Commercial real estate. Well, that's the part that I don't necessarily think I can offer you much edge, right? The only thing I can really tell you there is everything that kind of points to that. I didn't even point out the signals in the indexes long term that would also work in line with that. There's a signal here on the VIX that I saw developing. This is on the VIX futures that I think is important. So I'll show you this signal. Now, if you want to come to Austin, buy me a beer, we can talk about like credit events and tell each other scary stories. But I don't really from making money perspective, that's all that relevant, right? Like, does it matter whether it's a cheeseburger that kills you or whether it's a pizza, right? Like, you to go back to the analogy of the person that's overeating and gets a heart attack. It's like, oh, it was a pizza. Is it going to be the pizza, the hot dog, the taco, or the hamburger? Man, it doesn't really matter. It'll be something. But here's another signal that I'd point out to you here. So with VIX, I don't like to use the VIX necessarily, but I do like to use VIX futures /VIX. You can see the cloud here. This was at the beginning of almost, at the end of 2022. See how the cloud red. Looks a lot like bonds, right? Remember bond, the same dynamic, red, and then boom. Zoom in. See how the cloud is getting, see the baby green there that's showing in the cloud? So that's another signal that works in line with this. So you have bonds, you have VIX, you have the positive divergences. It's all up. The end result of what domino is it? It's a fun conversation, but the real answer is I have no idea. And frankly, I think it'll be something that people aren't necessarily prepared for. I think the commercial real estate's been very well telegraphed. Everyone's kind of expecting that. So if I had to give you a guess, which doesn't help you, but I'll give you a guess. My guess is something blows up somewhere, literally, in the Middle East, probably, and then that starts a cascade of problems. But that's not the point. The point is for us to speak a language and just anchor to the chart, multiple chart points that I showed you. The pink purple dash line is the it's the anchored VWAP. So you can add that to your charts. It's built into TOS. Just make sure you anchor to the beginning of the year. It's an extraordinarily helpful indicator. Anchored VWAP, average volume weighted average price for that time frame. It's probably one of the most, if not the most important moving average. And Andrew, last one. We'll do this. Last call. Any questions? Last call. If you have any. The more I've talked, the more the markets come back. So I kind of want to hang out with you guys a little bit longer. Maybe we can get this thing into 5,500. I have no business getting my money back on this trade. I was buying the market here, expecting for it to break out finally. Because look at this. This is like the 10th test of this pink line, and I was like, okay, this is for sure it. It was the high on Friday. It was the high yesterday twice. It was the high in the overnight session. It was the high this morning. I tried to buy it here. This is during my session earlier. I'm still long that same position. And I was like, okay, it's going to go for it now, right? This is like the fifth or sixth test of that level. The level's 89, 89 to 90. I get flushed out. And during my time with you good folks, I'm getting fun on this trade, which I probably don't deserve. But I'll take it if they give it to me. Do you need to be in the central room to get the toss in CloudCater? No, not at all. I put it in here. It's something I just whipped up for myself. It's extraordinarily helpful, and hopefully you'll find it helpful too. Just click on Files, SAM Cloud, download, put it on your platform. Try to give you guys as much free stuff as I can. TLT for March, Delta 30s are only $2. That sounds like a good deal. A few minutes. Let me just. I do want to take a look at that. So you're going all the way out till March. Honestly, that's a pretty solid place to put it. If you look at the expected move, you're not paying that much more for March than you are for January. Yeah, I think, again, this would be a longer term idea, certainly, but I think it works big. March 21st, TLT, anywhere between 100 to 120. 120 is a little aggressive. Anywhere between like 100 to about 110. Just accumulating those calls. I'm going to actually start doing that. I'm going to do that. The only way I'll be able to do it is if I do it in an account that I don't look at, because I don't like having long-term positions looking at me. But I'm going to start doing that. I like that, actually. I like that expiration too. So thanks for the idea there, Andrew. I like it. You write it down, actually. March 21st, 2020. I'm going to do that I'm going to do that almost as a savings account. I like that idea so much. What I'm going to actually do is I'm going to use my Robinhood as a savings account. I'll dump like maybe, I don't know, like 1K a week into this. And I'm just going to accumulate these calls for March in an account that I like that. I'm going to do that. I like the strike you chose. Yeah, when you try to download the file. So now we're getting into tech support. But what you want to do is download the file, go to Edit Studies, go to Import, and then import the file. Yeah, if you just double click on it, like it's going to think it's like a music file or something. Yeah, so just make sure you import it first. Once you've imported it, type in SAM over here. It'll be called SAM Cloud. You can rename it. You won't hurt my feelings if you rename it. It'll be called SAM Cloud, and then you can run it. If you do the option, you don't get the dividend. Yeah, no, I understand. My goal is not to get the dividend. In my retirement account, I get dividends from the bonds. My goal is capital appreciation based on the setup that I just showed you on LT. So I want to accumulate as many calls as I can between 100 to 110 in the March series, and the goal is TLT goes up even half as much as I think it does. That trade will double at least. All right, guys, I'm gonna go ahead and wrap it there. We went 45. We were scheduled for 30. So appreciate you guys. You guys are a little bit more active than usual. I very much appreciate it. It's always much more fun when we get engagement. So thanks for stopping by, taking time out of your day to learn. Again, I don't want to come across as scary or anything like that. It's just really just getting prepared. And if nothing else, go back and watch the recording. Take everything I said and say I'm completely wrong. Play devil's advocate against everything I show. And see if you can kind of disprove it, right? Look at it with your own lens, ask somebody else. Just try to disprove it as much as you can. If you can't disprove it, then you have something. And if you can disprove it, then send me an email, and I'm curious to know what I missed. But that's the story for today. All right, guys. Thanks as always. I appreciate it. See you next time. Cheers.